Hello, I am Mark Strosiak, Managing Partner with Infinium Investment Advisors. This is our market update for January 27th. Thanks a lot for tuning in. As always, this presentation is merely for informational purposes. It's not a recommendation to buy or sell securities or follow any investment strategies. We do not provide tax or legal advice, and always contact your own financial advisor before making any investment decisions. So with that, the topic today is inflation and taking a look at commodities. Is inflation finally here? That's the big question that we're trying to answer. And also we're going to take a look at commodities. What are commodities trying to tell us, if anything? And a consideration for you as an investor, is your portfolio positioned to take advantage of trends in the market, whether or not those trends are up or down? So jumping right in, this first slide, you can see that inflation, in our view, follows loan growth. So, the big fallacy that we've seen out there now, all these commercials on TV that, the Fed's printing money and, Ben Bernanke is a bad guy because he's printed all this money. That's going to cause inflation. That's bad, especially for seniors on a fixed income, that type of thing. Well, hold the show there. Not necessarily. What we've seen in the last several years, our banks are sitting on all this money that the Fed has been printing. So the money has not been circulating in the system. And the Fed, of course, doesn't like that. They want the money that they print to circulate, to reinflate the economy, and then, of course, pull that money out. At least that's the plan. And that's why they're paying you virtually zero on your money market accounts. They don't want that money sitting there. But indeed, that's what's happened up until recently. So when we look back into mid of 2011, we can see that banks are now finally starting to see positive loan growth. And that is an important difference between the last several years and where we are today. The purse strings are loosening up, people are asking for, and investors are asking for loans, and the money is starting to finally break loose. So now the Fed is really, they need to balance here between choking off growth and raising rates, which they just came out recently, yesterday, and said, we're not going to raise rates for several years. And let's hope they haven't boxed themselves in or have to renege on that. But nonetheless, this is a change, and it very well could bring inflation. And so we're watching this very closely. We have not been concerned about inflation. But if you start to see loan growth really take off, if you see a bottom in housing that we've been calling for a year ago, we called for it to happen this year. That indeed looks like the case. You could potentially see the rumblings of inflation, and so far inflation has been really benign. So looking at commodities, I ran this chart. The red line is gold. The middle line here in yellow is the S&P 500 index, and the blue line is a basket of commodities. And what you can see is there was a separation here back when the markets really started to melt down from the financial crisis, and of course gold spiked way up, and then really started to come back down. The markets and commodities, other than that, started to do much better. But what we've seen here really since early December is a rise in all three of these sort of in unison. And to us, that is very telling about the way investors feel today versus several months ago when, again, the European crisis happened. But what this is doing is creating trends. And we do see trends in the markets, not just in stocks and bonds, but in commodities, in currencies, in precious metals, and the like. One of the things we do here for our investors is we put them into potentially investments that can make money in both up and down markets. Certainly, this trend higher that we've seen in all three of the aforementioned investments will not continue in a straight line up. At some point, it will ebb and flow. It will come back down. Who knows where it will go. But nonetheless, it will not just go straight up. Therefore, is your portfolio positioned to take advantage of these trends as they develop, both up and down? Too many investors that we see do not have what we call alternative investments in their portfolio. And an alternative investment typically is an investment that doesn't need the stock market or the bond market to go up in value in order for the investor to make money. Some of these funds can indeed make money when the trend is down. So when you start to look at investments that can make money in both up and down markets, you end up getting this really nice risk-reward profile. And that's so valuable in a highly volatile market like what we've seen. How do you reduce risk yet not give up the opportunity for profit? So our consideration to you is your portfolio positioned? Does it have some of these types of investments in it? And if not, we highly encourage you to talk to your financial advisor and see if an alternative investment could potentially help you in the markets that we're finding ourselves in today. Again, I'm Mark Starosiak with Infinium, and we'll see you next week.